Welcome to our second segment of our market analysis. This is for October 21st, 2023. And in our second segment, we will look at emerging markets and lesson of the week. So what happened in emerging markets last week? This is as of Wednesdays, and you can see obviously majority of the markets were down. Still for the year, there's a lot of positiveness. So we're still ahead after really debacle of September. And again, October, we started strongly, as you can see from the charts, but October is a volatile month. So watching that closely. And you look at these charts, these are the 6-month charts. And again, we pay attention to the 50-day and 20-day moving averages. You see from the EFA to all the way emerging markets, from Australia to Austria, I mean, almost everything, Brazil, they are below their 50 and 20-day moving average. So you can see there's that weakness which started in August, really, and it continued in big time in September. So when I look at all these charts, at least visually, you can see that generally, I mean, everything has been going down. I mean, Sweden had shown some kind of a strength. I mean, India has been the most stable of all these markets. So, but look at South Korea. So there's a lot of weakness, but that's for the 6 months. We look at the variety of subjects, and as you know, part of it is the commodities, but also relationships between countries. As you know, China had invited from Middle East, there were visitors asking China to intervene in this. So in the meantime, Russia and China, they signed a grain supply deal that's worth nearly $26 billion. And this is what TASS, the Russian news agency, reported. So it's a so-called new land grain corridor, which that means that Moscow and Beijing planned to launch a late November or early December at the heads of state meeting. Now, what will happen is it eventually increases the exports of Russian grain to China, which is about 16 million tons through construction of a new infrastructure. So I think this is an important part. So there is, again, these partnerships continuing. I spoke about oil, so we talked from the technical side of things. So I want to take you to some fundamental side of things. Now, Saudi Arabia, obviously being a huge player in the oil market, they for 2024, the break-even oil price is about $80, and they have increased it, which is from the 6% increase from the forecast, which was done in May 2023. So that tells us that the floor for them is coming higher. And this is something that we want to pay attention. That's what sometimes these manipulations happen. But looking at other countries, producing countries from October forecast, and this comes from the IMF. You see, for instance, Qatar break-even is $42. Oman is $54. But when you get to Saudi Arabia, is 79.7. Azerbaijan is higher. Iraq is almost 100, like Kazakhstan. But look at Iran, it's $317. Algeria is 145. Now, March 21 forecast for the next 4 years, when you're looking at it, like Congo, Republic of Congo was 32, Angola was 42.5, South Sudan 43, and Nigeria at 162. So that's the fundamental side. Moving from Middle East and the oils and all that, moving to Poland just had an election. We had talked about that. And the reason Poland is important, obviously, its role with Ukraine. So Poland election surprise. It became a market-friendly coalition, and that shows that based on the exit polls. And what that means is they are going to be more as a central left pro-Ukraine opposition bloc have the votes to form a majority in the lower house of parliament. And basically what that means, it will be helpful for the markets. Basically, again, it gives the certainty, and also, it helped their stock market at that time. So there was, again, Hardlines was worried that there would be this disarray. And one of the reasons for this is they were threatened, by EU, that if they do not support Ukraine, they're going to cut off the funds. So with this, then that means that they're not in danger of losing the funds from the EU. So just food for thought. And this is based on valuation. You look at the Taiwan, and of course the relationship with China, from the price to book trailing 5-year valuation and earnings, and their foreign exchange and their interest rates, we see that Taiwan is really, based on everything, is one of the most expensive markets. Now, that doesn't mean it cannot do well. Like, look at India. It's also, but India has done so well. So basically, you can see these are the large emerging and markets, and then we compare it to Europe, where United States stands. So it's a comparison where really the markets are, just a little candidates. Moving from emerging markets, I'd like to share some lessons, and I hope they're helpful. And again, the purpose of our lessons are something that you can actually, it's a practical lesson, so you can take advantage of it. So number one, we hear about inflation, you think about the CPI. I just want to share, this is a website, it's called Trueflation.com. And it goes back and looks at, on a 1 week base, on 1 month base, and 6 month, and year to date. And so I looked at the 3-year, and according to this is hot off the press as of today. When we look at from January 30th of 2020, right before COVID, to now, it's been up. Inflation is up 23.9%. And that's a compound inflation. So basically what you can see, that's a big number. But even if you look at 6 months, you see there's a movement. So we are not definitely out of woods. So I just thought that's the reason they call it True, at least according to their, they're using their own barometer and then their own factors. This is what we are looking at. Something I forgotten to share last month, but we go and looking back, we've talked about seasonality and some of the things that we look at. One of the interesting things happens quite a bit, and it could be because of the holidays and a lot of influence in, let's say, Wall Street, is there is something called, from the seasonality, you sell Rosh Hashanah and you buy Yom Kippur. The way I would look at it, you can also sell short or get out of the markets. If you sell short, you want to cover on Yom Kippur. And this is just for this year. You can go back and look at historically. This is September 15th. So you would have either taken your profits or you've gone short. And here you would have just covered your shorts and start going long. So basically, again, you went down and then you would have been up. But generally, it's been obviously a very interesting year with so much going on. But it's just a little seasonality. You can put it in your arsenal and use it as an edge in the future. As you know, we use earnings whispers. There's so many earnings coming up. And of course, we had Netflix last week, which completely surprised, and it was obviously very good projections. Tesla, what happened? People still pay attention to profit margins. So what earnings whispers does, and this is again for your own benefit as well as having an edge, when the stock is highly disliked, so you look at the dislike, yet the company results are strong and there's a big surprise, it often receives a favorable earning whisper grade, indicating likelihood to outperform the overall stock market by holding for the subsequent quarter. And what that means, it is that surprise. So if I'm an analyst, and most of analysts don't like something, so they are not in the market, So because they dislike it. So when there's that surprise, there's so many of them on the sideline. Opposite is true when that they're widely loved. Everybody loves it. It's all these strong buys and buys. What happens is when they go weaker hand, then they all want to be out of, they just can't wait because they got disappointed. So it's almost again, basically it is that surprise element. So just a food for thought how you approach when you're doing your earning play and the stocks. Again, if they're a favorite of analysts, be careful when everybody loves something. When the time comes to sell, they're gonna be all out the door. Another thing what happened on October 18th, Lululemon, which is a Vancouver, Canada-based, it's athletic fashion retailer. They joined, as you know, Activision was purchased by Microsoft, so they're out of the S&P 500. So be aware that Lulu is, but also interesting that by the rumor sell the news, so we had a big jump, and then we've had, besides the markets, there was some sell-off, and you can see it's a huge resistance. But still, once things get, things turn around and they're part of S&P, obviously being part of an index has a lot of benefits. So just another lesson. I want to share this. This is one of my workspaces. As you know, I do a lot with Ichimoku. So this workspace, allows me just in one place to see is which asset class. So these are like the futures. Like we are looking, like I mentioned about like coffee, right? So by just looking at that, it's already can see, well, it just moved above, it is above the cloud, and the trend and turning line. So the turning line is up, standard line was flat, but it's moving. So I can differentiate as far as which markets I want to be. So it's just something I wanted to share with you, as far as you don't have to look at 1,000 charts, although I have a chart that, each one present, but by just looking at my workspace, it makes it a lot easier. Let's talk about the 30-year that we've been talking about. Talking about monthly, the 10-year yield, and we've been sharing this for the last, I think, 2 years, and we've gone using the Fibonacci. As you can see, we had drawn, and we were talking about that 23.6% at 4.17%. You see, we were rejected, we broke it. This was like almost a bull flag. We talked about, watch for this bull flag, and then we really now broken this resistance. As I mentioned, we hit the 5. So that's why we want to pay attention, and that's what I mentioned. I think if you go back a month ago, I had this chart, and we were, if you recall, we were at 4.42% at that time, and we said, well, there is this gap. This goes back to 2007 high. Is it possible we can fill that, at least get to the 5? And this is where we are today. So you can see how fast we move, and that's why this takes me to the next story. That's why what we are looking at is 99.9%. The market has discounted, saying that, you know what, Fed is not going to do anything in their November 1st meeting. Okay, so basically they're saying the markets are going to stay put, and because of that, because the markets are doing the work, or the bond market is doing the job. I want to go further, and this is, I shared this, it was September, again, a month ago, because I want to share the chart I shared. So a month ago, what the projection was from the, this is the CME Fed Watch, there was a 54.8% chance that the market will stay put. They will keep the interest rates, but there was 38.4% that it will go up to another quarter point. And this was for the following this November, which is the December's. So as of yesterday, now that 54 is 80% chance that they're going to leave the rates alone. And there's only 19.8% they're going to increase the rates. So market is watching that, but that's what you see the long end is really doing the job. Another thing we pay attention again as far as the number of the S&P stocks which are above or below their 50-day moving average, in this case above their 50-day moving average, and we can see the weakness. There's only 15% of the stocks have that strength. So what the way I look at it, we look at the extremes. So I mean, there was like almost, just beginning of October, we were at almost 7%. So that showed that there's a lot of extreme fear. And we go back to last year in October, we were like at 2.5. So that's why you had this big bounce. So the question is, again, that uncertainty. So watch for this. It's a contrarian indication or indicator. So basically find, I don't say bottom, but close to it. The last but not least, talking about the house and the budget and the interest rates. Boy, I'm telling you, the interest rates play a huge role. We have gotten used to, again, end of an era. We've gotten used to this low interest rate arena manipulated or played by the central banks. And it's not just United States, all over the world. So I want for you pay attention why it is so important to pay attention to the interest rate with all the debt that we have. We have so much debt. And this is just for the month. And what you can see, that the net interest, which is this, is $69 billion. And the national defense is $70 billion. So we are overall, once we look at that on an annual basis, we are at 630 billion, which is very close. This is interest. This is interest. And in the following years, we have to pay for this. And it's just going to eat up everything else because, the GDP will slow down. So the revenues will be down. So basically, we're looking at the social programs such as Social Security, the Medicare. I mean, you look at the Medicare, I mean, this thing can take over this if the interest rates keep going up. The average holding for the government is like 7 years. So they have to roll it. And then once they roll, it's a higher interest rate is coming. And as I mentioned to you, it's not just United States. My thoughts are because of the manipulation, eventually what they're going to do, they're going to constantly issue short-term rates to maybe retire the long-term higher rates once that happens. So the world cannot afford to have high interest rates for too long. So, but we are in a turning point. It's a new era, in my opinion. So that's why it's important to pay attention to these interest rates. With that in mind, I hope that was helpful. I will close our segment, and we will have our last and third segment. Thank you so much.